MCX IPF presents Simplifying Commodities, Futures, Options and Indices.
While equity, bond and currency markets all have their own unique levels of volatility, commodities are typically more volatile than all of them. Some of the reasons commodities are more volatile include issues with liquidity, potential exposure to natural disasters and geopolitics. The volatility of commodities makes them more popular with speculative traders and important for hedgers to hedge risk. Let's go through why commodities are more volatile. The first reason is the liquidity, which currently is high due to stimulus measures from central banks. In commodity market, liquidity is driven by producers, traders, consumers in physical market and by investors, hedgers, speculators, arbitrageurs in derivatives market. New products add more participants and add to volatility, as do new evolving markets. Weather and natural disasters impact commodity output. Cold in Europe would mean spike in natural gas demand and prices, while a drought in Brazil is bullish for sugar. Supply and demand are intrinsic to commodities. Weather inventory, output, trade, policies, pricing keep these prices volatile. And then because commodity reserves exist in specific areas of our planet, political issues in one region often affect prices. Wars or violence in one area of the world can close off logistical routes, making it hard to transport commodities from production areas to consumption zones. Tariffs, government subsidies, or other political tools also change the price dynamics for a commodity, adding to uncertainty and more volatility. Commodity tends to be highest in the asset classes in sense of volatility, and we are looking at quarterly volatility of some of these commodities. Crude has seen a range of 12.5% to 90% since 1983. Natural gas volatility has been 22 to 100%. Soybean has seen a range between 10 to 75%, while gold has seen 4 to 40% since mid-1970s. A more recent volatility chart of last 20 to 60 days tells you a similar story. The highest volatility here is since seen in case of the crude oil prices, lesser in case of metals, and the least in case of gold, because gold is a hybrid metal. It also is a metal and a store of value. Hedging has long been a way of global commodity buyers and sellers to mitigate the risk of price fluctuations. Hedging requires lower margin outlay and thereby offers a flexible price mechanism. It also improves profitability of organizations. So you can use options if you have an individual commodity to hedge, or you can go for index trade or index options to hedge a diversified portfolio.
MCX IPF presents Simplifying Commodities, Futures, Options and Indices.
Brought to you by MCX IPF.